So now we're going to turn to China, and we want to look at some of the things that have happened. There's good and bad in the mix of it, and we want to look at some of those key pieces. So when you look at the composite PMI, we already talked about some of it, but I want to last week, but I want to look at it all together because they come out at different times. So the composite PMI from the official numbers came in at 57. The manufacturing PMI was expected to be at 51.6, came in at 51.9, which is down from February. And that was what we expected with manufacturing, was a small bump, but a fairly sizable fade, because manufacturing, even though they were in lockdown, there was zero COVID policy, manufacturing never slowed the same way as non-manufacturing. But there's a lot of nuances in non-manufacturing, because government spending is actually rolled into non-manufacturing. And that's providing this bump because construction, which is improved, and the construction has improved, which falls under non-manufacturing. So construction's gotten better, but a lot of that is coming on the back of government subsidies and government support. And then government is supporting other things. So a lot of this is just, again, stimulus from the government, but then you're getting other pieces that are showing the stimulus isn't working. And yes, it's working here in terms of the numbers, the sentiment, because it is the way this index is calculated. And that's why we want to start looking at some of those nuances. And then you turn to the Caxton number, which from manufacturing was expected to be at 51.4, came in at 50. And we're seeing actually a more of a pressure to the downside in some of the leading indicators, which we'll talk about in a minute. But services was expected at 55, came in at 57.8. So composites still stay strong on the back of services. But again, there's a certain amount of setups within that. So now that's the look at the global piece. But now we have Catherine Tay coming out, and she gave a speech about trade deals. And it's interesting what's happening right now, because she was actually very instrumental during the Trump administration, and she's kept things a bit consistent, good and bad. And I'm not saying that that's good or bad, but there's been a lot of consistency with the way they're viewing managing the process. So she said past trade deals focus on aggressive liberalization and tariff elimination, which made the U.S. and other countries too dependent on China for critical materials. They also allowed Beijing to use state-led non-market practices to dominate key global industries. So essentially she's saying that getting rid of tariffs and eliminating them isn't going to generate free trade, but other means of doing so. The Biden administration's approach must address China's economic mercantilism by making strategic investments at home to better compete and strengthening our cooperation with like-minded economies to forge a fairer and more sustainable future for our people. Which again comes down to reshoring, onshoring. If you cycle back to segment one, where we look at the countries that are gaining more influence from the U.S., it's on the back of this mindset where, well, let's leave China and let's look at areas where we're not going to worry as much about tariff elimination, but more focused on how do we get that foreign direct investment? How do we create a diversified supply chain that has some implications and some investment that also comes within our borders as well as near our borders. That approach, she said, is the foundation for trade engagements such as the Indo-Pacific Economic Framework, the IPEF, and the U.S.-EU Trade and Technology Council. They will focus not on tariffs, but on regulatory, environmental, food safety, labor, and digital economy issues that have proven to be formidable trade barriers. So it's interesting because I don't disagree. But the question is, they can't be one-sided tariffs, where if we have free trade, they have tariffs. If both sides have tariffs, you're like, look, let's not fight over tariffs. Let's keep whatever this is. Let's look at ways to simplify the regulatory environmental framework so where you're not getting penalized. You don't, whereas What percentage is made here? What is the stamp of approval? And that's an interesting concept because we're essentially telling countries, if you have tariffs, fine. Let's come back to that. Let's get past some of these hurdles. And then if we need to, we can discuss what the tariffs look like. And that's not a wrong approach. I don't know if it's the right approach, but it is a very interesting backdrop. And I respect her a lot. I think she has some very good ideas, but this is obviously having the opposite impact with China because this is and she was a big influence in structuring the Chinese trade war. And again, not to say that it was wrong. It's just, this is an interesting backdrop. And it's definitely going to cause a response from China, which they've tried to go on this friendly tour, and it's just not sitting well with internally. And there's some pieces that have happened where they're going on that like pushing the education tour and alliance to the CCP. And again, that is going to be some of those overhangs that we're continuing to see in the underlying market. So now when we start looking at the China household liquidity preference and inflation, this is the interesting component because these indicators are missing something. And this comes back to the difference that we've seen in terms of where liquidity is, where activity is, but realistically, where is the consumer? Because if you look at non-manufacturing based on being American and how we deem non-manufacturing, which is services, which is typically more driven by the consumer is not here. So maybe these indicators might be missing something, but the household financial behavior will change as the economy recovers. But in every other reflation in China, a shift in household savings into demand deposits has preceded the recovery in the economy. But when you look at this, it's not happening. So household liquidity preferences, they've bounced off the bottom, but look at how soft that is. And that is a big problem. And now when you look at liquidity preferences, it's actually turning down again when you're looking at it. And then the asset and real economy price inflation is getting this peak, but this is coming down to those MVPs we've been talking about and what the consumer has lost in homes and facilities not being built, and this big drop down, which is again keeping the household on the sideline because they lost so much money in real estate that even though they've saved money, there's no impetus to go and do anything in the underlying economy, but there's some brighter spots with rising property sales, which you saw a big spike in construction PMI and stronger consumption. But the two sets of data this week show household financial indicators remaining very bearish. So that casts doubt on again, how strong can this recovery be? Because yes, you got the government pumping in, you got people starting to build again, but you don't have the consumer. And that has been our biggest concern going into this year when the COVID ended and everyone's like, oh, well, zero COVID ended, therefore the consumer's going to go parabolic. And it's like, well, but what health is the consumer in? And that's why we dug into some of these pieces and we're just not seeing it. So then when you look at some of the key pieces on that, again, this China liquidity preference. So first, the detailed monetary data for February shows continued strong growth in household deposits, but a further fall in the proportion of those held on demand. And it's difficult to interpret households locking up money in time deposits as bullish because they're essentially saying, I'm going to put my money there because I know I can get it back. That is not someone that is going to go out and spend and invest. So a lot of this construction, a lot of this building is on the back of, special purpose bonds, SPBs, some loans, but we've already seen that there is a huge issue with that on the leverage side, which is going to keep things a bit held back because at some point these provincial governments, local governments are so strapped for cash that eventually they're going to have to pull back. And that is where we see, there was a hope that that essentially the Chinese consumer would upend that, and we're just not seeing it. So that's a very consistent with the message from the second set of data from the PBOC's Q1 depository survey, which shows consumers favoring bank deposits over investments, the financial property and consumption. So again, that is not bullish. And when you look at the amount of bank savings, we know it's there. But as we showed, if you take bank savings and marry it with losses from the real estate sector, households are still 20% underwater. So there's no impetus for them to go out and spend, which again is why we remain concerned. So even though the non-manufacturing number is showing something really strong, it's on the back of construction and government, which is not bad. I'm not saying it's a terrible thing, but it's not with the consumer. And if you want to get a successful turn in the economy, this will be more of a blip, but as it fades, who's going to pick up the baton? And this is showing you it's not the consumer. And as we're now going into Q2 and you look at these numbers, there's not even a blip to the upside. It's just kind of trending down, now going sideways, and that's where we get this concern. So, but then when you look at China Beige Book, when you look at sales volume across commercial and residential, construction and commercial had a nice pop, real estate commercial, nice increase, but look at residential. Residential is still not seeing any type of recovery. And again, it's the tale of two cities where state governments, state entities are getting support, therefore they're building. But residential's like, well, we're not in any hurry. And again, that's where you're getting this kind of bifurcation of the government supporting things, but how long, given the strain on the government finances that we've highlighted. So then you layer that in and you look at the PMIs that we just talked about, but look at the new export orders. So in Caxton, the new export orders fell to about 49. So then you look at that, you're like, well, that's not bullish because that's in contraction. So new export orders are contracting. Then you look at the Chinese steel industry PMI, which reached 48.4 in March, falling by 1.7 from February, slipping into contraction after expanding for 3 months, which that's not stimulus. So again, you saw a nice bump. You saw it go into construction, and now it's dropping hard. And so you're starting to see that pullback on construction. So as the consumer stays flat to down and construction slowing, that doesn't lead to a lot of growth on the non-manufacturing side. Looking at the official export orders, you see that we're coming into 50.4, slight expansion, but again, still contracting and moving down. But when you look at the services, you have to break it into its pieces. So again, coming from China's Beige Book, the chart headline is why this point even has to be made, that no, services are not leading the recovery. Construction building is leading the PMI recovery. But what is the potential of success off of that? With China's manufacturing PMI subcomponents, construction went from 60.2 to 65.6. Services went from 55.6 to 56.9. But construction and government spending is supercharging this PMI, not household and consumer spending. And as you see that slow down in some of that construction, some of that steel, that's where we get some of this pause on this activity level. Sales and revenue and profit margin are bouncing, are rallying, but again, off of a low, and that's as it should. But how much can it continue if the consumer isn't there to support it? Now, if we turn to South Korea, industrial production took a sizable drop down. Was expected to be at negative 0.6, came at negative 3.2. Cyclical leading index change, again, negative. Trade balance slightly better, and that was just imports continue to be under pressure. Exports also under pressure. Exports was not as bad as expected, but again, still not moving in the right direction. Manufacturing PMI moving down, was expected to be at 48.5 in Feb, 47.6 in March. So moving in the wrong direction as CPI and inflation stays elevated, which again, more of that stickiness that we've been talking about, which is going to keep things problematic as you see a steady decline in South Korean activity. Imports coming down, leading indicator for local demand as well as export demand. Exports coming down, manufacturing PMI coming down. Again, all of this is moving in a negative, and it's going to flatline. It's just going to flatline in contraction, as you can see from the projection for Korea's economy, which remains weak. And you can see things starting to roll over. And given inflation where it is, it's going to be difficult for the Korean central bank to really cut anything and do anything in a meaningful way to improve the situation. So now if you look at India, the 8 infrastructure industries in February, the prior was 7.8, came in at 6%, still positive, but moving down. Fiscal deficit, as we've been saying, the fiscal deficit is increasing, which is going to be a problem in the longer term, but it's having positive ramifications now. So manufacturing PMI was at 55.3 in Feb, came in at 56.4 in March. Composite was at 59, came in at 58.4. So it came down, and that was driven by services. So services was at 59.4, came in at 57.8. And the service side, as we said last month, services is where we see some of the pressure points, because manufacturing still has a little bit of that support, but the services is where we see a rolling over, because there's a lot of stress that we've been seeing on a lot of our data sets that are more shipping related and internal related, where you're just seeing the local consumer in India slow down. And that's where we see some of these problems, which also brought the RBI repurchase rate was expected to go up a quarter point. They kept it flat. And that's where India is just pausing at the moment. They want to see where things play out. Inflation was still above their target, but below estimates. And they just want to sit and see where are we right now and where are some of these underlying flows. So here you get an idea of, again, still kind of rolling over, but still at a fairly stable level. We think services just continues to trend closer towards that 50 level. Then you look at Japan. So when you look at Japan, the CPI accelerated again, was expected to be at 3.2, came in at 3.3. Retail sales were better. Department store sales, again, slightly worse. Industrial production still remaining a bit elevated, but manufacturing, a slight uptick in March. In February was 48.6. In March, 49.2. Monetary base, again, maintaining. When you look at services, still moving higher. So with services moving higher, composite moving where it is, you're still getting this inflationary pressure, which is why the bond buying is going to have to slow. And that's and you've seen it here. Japan buying of foreign bonds, of stocks, is coming, when you is starting to slow down, especially when you look at office vacancies ticking back up. And that's, again, we think the BOJ is going to have to raise rates. They're going to have to essentially alleviate this ceiling to try to bring some of this in control and to bring CPI back down, which is very elevated versus historics. So that's what we have for you on Asia. If you have any questions, please feel free to reach out. We'd love to hear from you in the comment section on Twitter. And we hope you have a great Easter and a great Passover, depending on whenever you're celebrating it with family. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.